Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today and his firm are known for some very deep quality research that they've come out with on both macro as well as the micro. And it was pertinent that at the start of the year, we get in Spark Capital's Ganeshram Jayaraman to talk about how he sees 2022 shaping up. And as much as it is a repeat conversation because we've done it with so many people, it'd be pertinent to try and figure out what are the pulls and pressures for the economy and the markets at large, as well as for some of the themes on which they are in sync with some thought leaders and out of sync with some thought leaders. So they have a contrarian view as well, and which is why I'm looking forward to the next 20-25 minutes of this conversation. Ganeshram, so good having you. Thanks for joining in, and I hope all is safe in Chennai.
My pleasure, Neeraj. Always nice speaking to you. All well here in Chennai.
Yeah, touch wood. It's a pleasure having you, Ganeshram. So let's start off with what seems to be a consensus view, which is that higher interest rates, slowing global trade in 2022, and the fact that the valuations are stretched would mean that equity markets returns, while nowhere near 2021, will likely be flattish or maybe just marginally higher than the current levels as the markets may be. What are your thoughts around both the economic macro and the growth that India could have in what is arguably going to be a year of slowing global trade, and what could that imply for equity markets at large?
Sure. We actually called it a day three pitch in some form in terms of how we saw the macro play out. What we mean by day three pitch is, in a cricketing parlance, a day three pitch is generally seen as the better batting conditions better pitch conditions to bat on. In our assessment, the first 12-18 months of increasing interest rate environment is good for equities. Okay, it might be bad for bonds, but it's good for equities. Because why does interest rates go up? Why do central banks normalize their monetary policy? That happens because demand conditions are kind of improving, right? And that means that's good for broader top line growth. And it also, inflation is in some form good. It's a tailwind. It's not a headwind. In the first 18 months, initially it's a tailwind. And eventually, if it lasts too long, it will come back to bite us. But in our assessment, inflation means pricing power. Companies will be able to take price hikes in the context of demand recovery. Now, demand recovery, industry consolidation, and inflation, when it comes together, it's very potent force for top line growth, and it shows up as operating leverage, and companies will be able to see will be able to take price hikes without having a detrimental impact on their bottom line. So we think in our assessment, so cyclicals offer a lot of earnings upside. It will appear costly on valuation multiples, but the earnings have a lot of upside in the sense asset turns for many of them have halved over the last maybe 5, 7, maybe even 10 years for some companies. Margins have maybe down a third from where it was, and asset turns will lead to operating leverage. So broader construct is very positive for us into next year as well. We think the economy's ability to absorb the oil shock, if any, is also a lot better today. Historically, when I mean historically, say the last 5, 7, maybe even since 2013, I would have said India's tolerance threshold on oil is about $80. We think that's gone up to close to $100 currently. And that's a combination of various things. One of the key reasons is IT exports. IT is, while trade deficit is on its way up, we in India should look at current account deficit a little more. And the reason is invisibles, which is combination of both IT sector and the inward remittances which come. India got $80 billion of inward remittance from the non-resident Indians. And so the current account deficit matters more. We think even if oil is up to maybe even closer to $100, our current account deficit will be a shade below 2%, even in a scenario of $100 oil. So, which means the capital flows should be strong enough. In our assessment, the bond flows should be healthy enough. India should logically get added on to some of the bond indices this year, and that should lead to pretty healthy inflows on the bond side. I actually also think the rupee should be strong this year. Contrary to some of the concerns, we think the likelihood of bond flows are pretty strong, in the sense the bond yield differentials between US and India is close to 500 basis points, whereas the inflation differentials is negative. In other words, US inflation is more than India's inflation, which actually is a very strong reason for bond flows to come in, and which should again support the rupees front. So broader macro inflation, interest rates, policy action by central banks, we don't see India likely to see a headache to equities due to any of these things. So which means
Yeah,
our
Ganeshram, can I just maybe ask you a cross question and then you can broaden that point? I'm just wondering, from the looks of things, CAD currently seems to be tracking a number northwards of 2%, right? And maybe it will settle down, but northwards of 2%. And the fact that, I mean, I was looking at a data point, I don't know, please correct me if I'm wrong, but I was looking at a data point that the percentage of GDP, both inward remittances, the invisibles plus IT and other exports, I since the last 4 or 5 years as a percentage of GDP haven't really moved up. So is there a cause for concern, or do you reckon that it was a period like that which led to it and then things will improve going ahead?
No, it's actually gone up in the last 18 months. Economy shrank during the last 12, 15 months, and then has gone back to its pre-COVID levels. But IT and remittances are well above where they were pre-COVID. So as a proportion, it's actually gone up during the last year. You're right. In the previous 3 years, you're right. In the last 18 months, it's the proportion has actually gone up. So that
Marginally,
is at the margin, it's gone up. So clearly for us, when we study the macro, we are not seeing a reason for us to anticipate an alarm during the calendar 22.
Okay.
So though we do see central banks tightening monetary policy, we do see Reserve Bank of India tightening liquidity. They've already started it in some form over the last 3 months already. We do see rate hikes by them as the year goes, but we have seen it in 2005, 2009, second half 9, or throughout 2010. We saw it in calendar 14, second half 15, whole of 15. That even if in the first phase of rate hikes, there might be the 1-2 days kind of worries, but eventually it will settle down. The first phase of interest rates going up is good for equities because it indicates demand recovery. That's our fundamental point. Eventually it will come back to impact us if inflation lasts too long, but we don't sit in that camp as of now. We think inflation will also be in the stable territory in India, led by pretty moderate food inflation.
Got it. And should those change, then of course you will come and change your thesis as well. But for now, the thesis remains this. Okay, fair call. So this is music to the ears, Ganeshram, because the most common view, as you would obviously know, seems to be that led by the world markets coming off, there could be some pressures here and now. Let me try and understand from you, therefore, what do you think could be the construct of the next 12 months? I'm just using 12 months as a barometer because too long a time frame is difficult these days. What could be the construct? Could it be the return of some of the trades stroke investment themes that haven't done well for the last 12 to 18 odd months, banks, autos, etc., or maybe even staples, if you will? Or do you think the likes of information technology and some of the others, which have been rank outperformers and which are talking about strong growth even in 2022, will do well? Because the problem out there, the valuations seem to be a bit stretched. So what's your sense here?
Yeah. We are looking at a cyclicals bias in our portfolio. When I mean cyclicals bias, it's two separate things. One is the urban discretionary consumption. It could be autos, real estate, or consumer durables. Some of those themes in terms of it could be leveraged, but not necessarily leveraged, but discretionary consumption, very urban centric in character. Okay, that's it could be passenger cars or even electric vehicles led, and digital is definitely one of them. So discretionary consumption, urban centric, rural we are more cautious, more on two-wheelers or on tractors or even staples. We are a little more cautious on the rural consumption side, but definitely on urban side. That's one side. I'll dive into it. The second part is where our maximum overweight stands currently is on the industrial side. We are actually very confident on the capex cycle picking up. And when I mean capex cycle, it's all kinds of capex, household capex into real estate, property. I mean, it could be corporate capex, both private sector companies as well as PSU companies. Okay, they undertaking capacity expansion. We are also confident of government's infrastructure spend actually continue. It's likely to grow close to 30% during the current financial year. On that base, it's likely to grow 15% next year in our estimates. That means the impact of the rub-off of that on cement or steel on the dikes or thereabouts. The fourth is exports. We are seeing pretty strong signs on our export side, on engineering goods, on the reflationary spend, which we are seeing globally, reflation spend. So clearly, all four drivers are in some form helping us out in India. So clearly for us, confidence is on the industrial side, which means it's a combination of it's capital goods, both on even some of the consumable industrials, cement for sure, property, construction. This entire pack is something that we are maximum overweight on in our construct. So discretionary consumption by households and discretionary consumption by corporates, it's in some form our primary call. And we are overweight on banks, but that's a very different reason. It's not really credit growth, which is what the street tends to look at. And we actually are in the view that credit growth will remain muted. And the primary reason banks have underperformed, especially the last 12 months. Calendar 20 was fears of NPAs due to lockdown and some of the overhang on the court cases which were there. But calendar 21 underperformance is because, and we kind of agree with the street that growth will be below ROE. Okay, and if growth is going to be below return on equity for an extended period of time, then the dilution, keeping in mind the overcapitalized balance sheets, next 5 years I don't see banks, most of them raising capital, which means this book value bump up due to growth being better than ROE, which drives the multiples, is not going to happen. So the multiples have mean reverted. Okay, most stocks today are 1 to maybe 2 notches below their 5 year, 10-year averages, which means this expectation of capital raising not happening over the next 5 years largely is in the price. Whereas we actually think ROEs will expand. Okay, it's a combination of various things. If you study the income statements of banks, or in balance sheets of banks, you'll see net interest margins have upside. Gone are the days when banks pricing when interest rates go up used to lag the central bank effect. Today, most proportion of the, or maximum proportion of the banks' loans are repo linked. So when repo rates go up, banks pricing will simultaneously pick up. Earlier, you used to see margins under pressure. We don't see that happening. In fact, the CD ratios of banks are well below what they've ever been. Even some of the larger private banks, they used to operate at close to 85-90% credit deposit ratio. Today they are, some of them are even below 80%. So there is upside on the interest or the loans led mix within the balance sheet between bonds and loans. That mix will also be a margin driver. Fee income has upside. Operating leverage is there. Banks have been investing a lot on technology. You will not find them kind of investing on branches and people as much going forward. So you will see an operating leverage play out. The biggest upside is credit costs. Banks are still over provisioned, and we will see a recovery cycle. When I've seen real estate cycle do well, and when the metals when the metals do well, typically the past cycles NPA see recovery. So we are confident of that. So which means practically every aspect of the bank's income statement has upside. Return on risk-weighted assets is something that we monitor a lot. The risk-adjusted pricing, we see some of these, the quality of earnings to improve for banks, quality of return on equity to improve. And that's why we are focused more on those aspects, and the reason why we are overweight on banks. It's not credit growth led. Credit growth will remain muted, especially corporate side of things, at least for the next 12 odd months, 15, maybe 15 months also. But credit growth is a lag indicator. I've seen it in 2004 when the sanctions start, both home loans. You sanction a home loan today, but disbursement doesn't happen immediately. It comes with a lag. Same way on capex also. The sanctions will happen this year, or maybe it'll get into early next year as well, but it won't get disbursed now. It's a lag indicator. You saw it in 2004-5, as I was saying. It happened in 12-13 also. The the uh, the capex cycle was winding down, but corporate loans growth continued to be in 12-13%, even in calendar 12 and 13. And then for the last 7, 8, 9 years, you've seen no credit growth on corporate books. So you will see a lag indicator on credit growth. So market focuses on credit growth. We are contrary to that. We think credit growth will show up with a lag. Right now, we are focused on other aspects. Loan will pick up 18 months later. By then, you don't get these valuations. So we are overweight on banks for two separate reasons.
Got it. I'm just wondering, I'll just probe each of these points one by bit and then maybe move on to something else. For banks, therefore, suffice to say 2022 is improvement of internals, and maybe 2023 onwards growth could come back, if you will. What kind of banks are you looking forward to, Ganesham? Because if earlier the street was divided, and I'm using names here just as an illustration, that there was HDFC Kotak, then there was ICICI Axis, IndusInd, and the likes, Axis in the likes, and then some of these smaller banks, and then the PSUs. Do you think that kind of nomenclature stroke pecking order has changed, if you will? And are you preferring the smaller over the larger? Are you preferring the non-top quality versus the top quality? What gives here? Are you preferring PSUs, for example? Who knows?
I can't talk bank specific names here due to our compliance restrictions, but clearly I will be second in the pecking order on quality, which will be my preference on the banking large banks, and clearly prefer large over the medium and small size. But it's that one notch lesser in the pecking order on quality, which is where the delta is more in terms of credit costs, operating leverage, or even growth. We will go for that notch lesser in the quality, where the upside is even more. So clearly clearly banks over NBFCs to start with. Okay. Within that, large banks clearly over medium-sized banks, and within the banks, it's this mix, which is our pecking order.
Okay, thanks. That helps. That helps. Okay. The second point you mentioned. Discretionary consumption, urban focused. Can I actually get to the cause before I get to the effect? And could one of the causes be that in India, some of the urban centric sectors are doing remarkably well? Information technology thus far and the salaries thereof. I could almost argue that even though it's nowhere as large as information technology, but specialty chemicals and the kind of tailwinds that space has got, and therefore all the salaries in that pocket have done really well. And some of the others, fintech, for example, and what's happening in Bengaluru, Hyderabad, maybe Chennai, Pune, etc. So are you bullish therefore on the cause as well? And then get down to the effect. Do you think that is the reason why you are bullish on, for example, real estate?
Yeah, see, the most important reason why we are positive on urban discretionary consumption, and also let's understand urban a little deeper. It's about 15-20 cities that we are talking here, and the suburbs included. So the reason is, one clear reason is IT is hiring, and in our assessment between fiscal 22, 23 and 24, in these 3 years, the IT BPO startup ecosystem, right, in all three put together, should be generating something like about 4,50,000 net additional jobs each year. Okay, each year. So that's about 1.35 million jobs. Okay, net addition. And this what this means is about almost a third of the graduates passing out get a job in IT. Okay, this has never happened. It used to be 10, 15. I'm not just talking engineering graduates. I'm talking here of including arts science graduates, and maybe I'm excluding the medical graduates here, but pretty much the entire graduate ecosystem, one third of them get a job in IT. Okay, this has not happened for at least 15 to 18 years. And it used to happen in the first 5 years of this century, but since then we have seen this proportion keep coming down. One is jobs. Second is almost the entire industry has got a 15% plus wage hike. Okay, this year and the current financial year, and it came into effect maybe 3 to 6 months back. Okay, and the rub off of that, when you put these two together and see the wage mix, how much of them were below 5 lakhs, how much of them are above 10 lakhs, how much of them are above 15 lakhs today, you see the second, third order derivatives of this very significant for us. Where are these jobs coming? It's coming in the Chennai, the established IT hubs also, but bigger growth is in the tier 2 cities. The Coimbatores and Trivandrums and Kochins, or even Kolkatas of the world, right? Mysore's. So Vizag's. So the distribution of consumption, okay, is a very significant part. We are understanding from managements how well they are preparing themselves for a far better discretionary consumption growth. We are asking them, are you seeing this? We are asking banks if they are seeing the salary accounts growth in these cities ranked say between 8 and 25. Okay, are they seeing bigger growth in savings bank balances in those cities? Okay, we are clearly noticing property recovery is faster in those cities, for example, than even in the top 7. Okay, so for us, the second tier cities are going to be our primary growth drivers, and IT is one, but also the second order effect of it. See, when Narega came into effect in 2009, all was spent was 30,000 crores. But what it did was it lifted the entire rural wages up over the next 3 4 years. And if you recall 2011 to 14, in almost 4 years, mm, staples companies saw 15 to 12 to 15% volume growth, which they had never seen before that, and nor have they seen after that. Okay, but what Narega did was it lifted rural wages up. Now the question for us to ask is, if IT sector is going to hire like this and give wage hikes like this, where can the other sectors be forced to match wages? Else they are going to lose talent, which means wages in general, the inflation on the power of negotiation is now going to be more with people, okay, on talent, and that's going to result in strong wages led consumption effect into the economy. That's one of our very critical structural drivers. And I'll possibly say next 3 years this should be one leg up which will happen. And keep in mind that this has various ramifications. For example, on commercial real estate. Okay, uh, as I told you, 1.35 million jobs. Okay, right now work from home, but it's not going to last forever. Okay, and even if you work with about 100 square feet per person, and you're talking here of 135 million square feet, and that means it's almost 35-40% higher commercial real estate space requirement from just IT alone, and rub off of that on the labor, blue collar. Mind you, a fourth of blue collar labor is in construction in India, both residential, commercial, or infrastructure. Ah, the rub and the impact of that is pretty significant. So for us, all these aspects, and let's also not forget one critical thing. which we tend to ignore as impact, but it's very significant, which is in the last 21 months, we have had equities, bonds, property, and gold give returns in excess of inflation. And while incomes have been impacted, balance sheets have actually become better. While equity is a small proportion of the population which could have benefited, gold and property are a lot more democratic, and the impact of that, loan against gold for some of the largest banks have actually gone
Yes.
up,
Yes.
doubled to even some cases tripled during this period. The bottom of the pyramid businesses, the shops and households have suffered, and they have survived because of more gold, monetization.
Yeah.
Or the SMEs, the ones who borrow $1 million to maybe $3-4 million, they have been able to benefit because of either the ECLGS scheme by the government
Yeah.
or on loan against property, okay, which have helped them monetize their real estate. What had happened the previous 4 years, banks had cut their LTV and they hiked it up, and that
Yeah.
helped in many of these SMEs get survival capital, and that has helped them. So when I look at the rub off of asset prices, and I see how that could potentially, it has and it will continue to be a benefit for consumption. Confidence on discretionary consumption is only getting a little stronger for us.
Okay. So I get the whole logic, and for large discretionary consumption items, maybe I don't want to get into detail, but I do want a small detail from you on two aspects. One, by virtue of the fact that when you believe that IT companies will do all the hiring that they do you reckon that IT itself as a sector, despite the valuations, is still a sector to stay invested in or make a fresh investment in? That is part one of my question. Part two of my question, I heard you mention the kind of demand that comes into commercial real estate. The street for now is sold on residential real estate. We've seen the numbers coming by from almost every company, including over the weekend as well. My question is, are you constructive on commercial real estate stroke REIT companies by virtue of all the arguments that you just made?
We've been wrong on our call on the IT sector. We were really early to pick it, but we kind of went cautious on it a little too soon, and we have been wrong over the last 12 months on being underweight on that space. But we continue to hold on to our view that these companies are doing great, but we think the street's estimates are too buoyant. We see likely downgrades and we have seen downgrades, but stocks haven't reacted to it. But we continue to be cautious on the space, and our preference is derivatives of IT as our bigger upside. We saw it in 2004 to 7, okay, when IT was hiring, when IT companies were growing their top line, but margin pressure was telling, rupee appreciation was showing up on the multiples and stock performance, and that sector was, though not not that it gave big negative returns, but it was a relative underperformer during that period. So we remain pretty much on that camp, that to see the benefit of IT sector, the second order derivatives are better proxies.
Okay. And what about the differentiation in real estate? Commercial real estate REITs, are you bullish there?
Commercial real estate, we don't cover some of these REITs
Okay.
stocks, but commercial real estate rub off due to the points I mentioned, and also we are seeing some pretty smart pickup on the whole data centers side of things, and that will also
Many
play
ways
out.
to play it, right? I mean, there's probably one listed play which has got data centers as its, or two maybe. The other one is not even listed, even though he's a large real estate player.
No, actually, you can look at various things. The switch gears and air conditioning. For example, is a pretty. These are centers which need heavy cooling. Okay, and the centers where it's coming up, for example, say in Chennai or in Vizag, you know how the weather is, so it needs a lot more intense air conditioning requirements. So clearly, automation is an important part. There are stocks which will benefit with what we are seeing on the data centers as well.
Got it. Got it.
Cabling, for example.
Sorry?
Cabling.
Yeah. Okay. Fair call. Oh, did I hear you say gaming? No.
Cabling.
Cabling. Yeah. Sorry.
Yeah.
Sorry. I misheard. Okay. Though gaming is also picking up, but that had no connection to data centers. I was just wondering if I misheard that. Okay. My final question, Ganeshram, is on the capex cycle. Last week, Ganeshram, my colleague Nikki did a very detailed note on what may drive the capex cycle going ahead. I gather from the notes that I read from your end, from your house as well, that you guys are constructive on that pocket. Can you lay it out for us, the nuts and bolts? And because it's such a wide bucket, which benefits if there's a capex revival, where do you park your biggest buck in that pocket?
Capital goods companies and construction. Okay, so we are, as I said, the biggest overweight stands is on the whole industrials pack, and it's a pretty wide basket. It starts with real estate, construction. It will capital goods, some of the consumables companies for sure, cement. It's a wide exports also. Some of them, or even I put a commercial vehicle as part of industrials. I'll put maybe some container companies there. Possibly at the air conditioning points, I told you the PLI beneficiaries, some of them. So this is a pretty wide basket, and that's where a lot of earnings upside can play out. These are companies who, as I told you, right, corporate capex, household capex, government's infra spend, and exports. The drivers are many, and when I look at the balance sheets and income statements of these companies and study 20+ year trends, not the last 5 years, not the last even 10 years. There have been down cycles throughout this period. You need to study how these companies performed in the previous upcycle, and then see whether the company's product profile as it improved, as the competition deteriorated, as the market share gained. Is the product suite relevant today? Okay, and how well the managements are prepared from capacities perspective. Look at asset turns, look at margins, look at the improvement they've done on their cost front. And if you study this, and we have spent a lot of the last 12 months doing this, and we are confident of a lot of companies there. They might appear to be 50 PE or 60 times PE, or sometimes even 40 times EV EBITDA, but they're all misleading. They are bottom of the cycle earnings. So, where asset turns have halved and margins have come off a third or even more, and the industry structure has improved. I can just tell you, 10 years back, you can just look at how many construction companies were around, okay, competing with each other, undercutting in the previous capex cycle. Today, you can look around and see who meets the technical criteria needed for any new steel plant or cement plant or a refinery project. Who is eligible with technical criteria qualifications to meet, and how will that impact pricing eventually? So private capex is a pretty strong driver of earnings. I mean, top line and earnings growth for industrial stock. And this is another medium cycle, 3-year cycle, which we think is started on. There are multiple drivers there.
Just the conviction shows in your answer, Ganeshram, and really appreciate that. But this was lovely. Thank you so much for spending the time and talking to us in some detail about a bunch of things. And look forward to many more such conversations, Ganeshram.
Pleasure's mine, Neeraj. Thanks.
And viewers, thanks for tuning in today.